Good morning, my friends. Welcome to another edition of the Heritage Wealth Planning podcast. Just got done doing a podcast, a YouTube channel. I got an interesting email from Social Security this morning that I want to share with you that I think you'll like quite a bit, actually, because it just shows you how you need to be on top of your Social Security statement. I'm just telling you right now, it is critically important for this. And unfortunately, because they're not mailing it out anymore, you're not going to know about this stuff unless you go to socialsecurity.gov, SSA.gov, and actually sign up. Now, a lot of people will say, oh, I don't want to sign up because I'm worried about it being fraudulently taken from some prince in Nigeria or something like that. And I'm going to show you why that's always a concern, but not a huge concern to me, frankly, and I'll show you why. But this is actually, so remember, the basics of it is the Social Security sends out just a ton of mail each year. All that mail costs something to somebody. A lot of that mail gets, I hate to say it, but it gets stolen. It gets lost in the mail. And there's a lot of critical information on you about your Social Security records. So Social Security says, we're just not going to do that anymore. Unless you're 60 years old, then they will send you the letter of your Social Security benefits. But anyone under 60 will not get that. And so the only way for you to understand how much your benefit will be is to actually go on socialsecurity.gov and log in, create an account, and it'll give you the list of all your earnings and whatnot, and it'll recommend or suggest you what your future benefits are going to be on. And I'm going to get in that here in just a second, because that can be problematic if you're banking on that for your retirement. But anyway, so Social Security says, look, we're costing a lot of money. We are not in good financial shape. So we're going to stop sending those out. We want to go green. Everybody wants to go green. It's silly, but I get it. They're saying we want to save the environment. Well, they're just saving money, and that's fine. So they're going to save the money. And we're not going to put that in the mail anymore. So you got to go online to figure it out. Well, the problem is how many people actually go on to socialsecurity.gov to actually look at their benefit statement and read the fine print in there to figure out how that's going to affect them specifically. And the answer is not that many. So let me show you what happens when you go on socialsecurity.gov and you sign up for an account. You'll receive this annual reminder. And I just got this morning, which is pretty sweet. I actually love it quite a bit. Annual reminder to review your Social Security statement. All right, and I love it. It says, we'd like to remind you about your Social Security statement online. The statement has important information, blah, blah, blah. On June 10th, 2017, we added a second method to verify your identity each time you sign in, and I'll show you that right now. So let's show you what they come up with. So you click on here, or you click on this link, and it'll take you to a page, and I skipped through that because I had my personal stuff in there, and I don't want the whole YouTube world to see it, but it'll take you to a page with your email and your password. You just click on that. Now, your email is visible. Your password is not. So I probably could have shown that to you, but rather not. So you take it to that page and you click on next, and then it'll take you to this right here. And you'll have your cell phone or some other second level of authentication. So two authentication levels. And here's my last for my cell phone, 6810. Click next. And it'll take me to the page, which will give you all your earnings, and even have this friendly little person jumping up here to if I need help with something. I don't know if they're online on a Sunday. I don't know. I don't need help right now, but I think it's pretty cool that they get this pop up. So one thing I want to share with you that's critical and important is, first of all, how you qualify for benefits. I already talked about that in the YouTube channel, and I'll link to it here. That's actually, I don't think that important, because all you need is you need 40 quarters of credit, and you need about $1,500 per credit. So if you make $1,500 in a quarter, $1,500 in a year, that is considered one quarter. 15 times 4, what's that? That's $6,000. So if you receive $6,000 of earned income, that's considered 4 quarters, and you need 40 quarters total. Does that make sense? Let me just reiterate that, because I'm confusing myself. So if you make $1,500 in 1 year, that's one credit, one quarter. You need 40 quarters to get your full Social Security credits. All right, so if you make $6,000 in a year, and it can be in all one fell swoop, it could be over 365 days, it could be in 1 month, it doesn't matter. If you make $6,000 a year, and now this is indexed for inflation, it's adjusted for inflation. So if you make $6,000 this year, next year will probably be $6,200. But if you make $6,000, and I'm not getting this to a specific dollar, it might be $1,553 or something like that, I don't know, but just use that $6,000. If you make $6,000 of taxable income, That's 4 credits in 1 year. All right. So that's the max you can get in any calendar year is 4 credits. So you got to do that 10 times. So all you need is 10 years. Yeah, 10 years of roughly in today's equivalent of $6,000 a year, and you'll get the full. You're entitled to your full Social Security benefit amount. Make sense? Now, just because you're entitled to the full amount doesn't mean you're going to get the full amount of Social Security. Just means you're going to get your full amount based on your earnings record. And I talk about this in other episodes. I'll link to there. Remember, it's your average index monthly earnings is how your benefits are accounted. So your AIME, average index monthly earnings, and that's based on all the credits you've achieved each and every year. And they take your top 35 years of earnings, and that's how they figure out your AIME, your average index monthly earnings. So your top 35 years. So when you were, bussing tables as a 16-year-old boy in your dad's restaurant, making, $2,000, every couple months, that's good. That gives you enough credits to qualify for Social Security, but that's probably going to be wiped off the mat when it comes to your top 35 earnings years. Your top 35 years of earnings, I should say. Now, it might not be, I don't know, but just in the back of your mind, all that earnings that you had actually is good, even if you didn't make that much money. It doesn't hurt you in your overall average index monthly earnings because they only take the top 35 years of your earnings record. But it does help you in terms of making sure you qualify for those 40 credits that you need, all right? 40 quarters of credit. So you need that. So 10 years essentially. All right, so now you take AIME, and that is based on your 35 years of top of your highest earnings of 35 years. Now you use that calculation method I talked about where you get your PIA, your primary insurance amount. Your primary insurance amounts is how much you're going to get paid once you file at your full retirement age. Up until 1960, your full retirement age is 66 years and some months. After 1960, your date of birth, your full retirement age is 67. So I was born in 1970. My full retirement age as we sit here today is 67 years old. Your FRA, full retirement age, is when I can get 100% of my PIA, my primary insurance amount. This is critical, and this is why you need to be logging on to your Social Security record to see what that number is. Your PIA is the amount you're going to get at full retirement age. If you take Social Security before your full retirement age, as the vast majority of Americans unfortunately do, you will get a reduced benefit up to 75%. It won't be reduced up to 75%, it'll be reduced to 75%. So again, if your PIA was $1,000 a month and you file at 62 years old, you're going to get $750 a month in today's numbers. That's based on a full retirement age at 66 years old. So just remember that. Your PIA is 100%. That's 100% of your full retirement benefit. If you file early, you'll get a reduction up to 75% or up to 25% reduced. If you file later than 66, and again, I'm using someone today who's 66, you get an 8% increase up until the age of 70 years old. Now it's simple. It's not compounded. It's simple interest. So you can get, if you're getting that $1,000 a month as a PIA, and you file at 70, you'll get $1,320 a month. If you file at 62, you'll get $750 a month. So it's $750 early, that's $1,000 full retirement age, and it's $1,320 late. Does that make sense? Critical to know. Now, here's what Social Security is going to tell you. It's very interesting, actually. So already talked about how you qualify, how we estimated your benefits. If you have enough work credits, we talked about those 40 credits. You got to have 40 credits to get the full benefit. We estimated your benefit amount using your average earnings over your working lifetime. That's your average index monthly earnings, which is adjusted for inflation. So they do index for inflation. And again, just look at my previous videos to show you how that works. For 2018 and later, up to retirement age, we assumed you'll continue. This is critical. For 2018 later, we assumed you'll continue to work and make about the same you did in 2016 and 17. Now, here's why that's critically important, my friends, because look at me for an example. I'm self-employed now. I start my own firm, Heritage Wealth Planning. There's no way I'm going to make the same amount of money I did last year or the year before. But Social Security is thinking I'm going to, at least for this year. So if I were to do some financial planning, and I looked at my Social Security statement, which I did on this on SSA.gov, man, it looks like I'm going to live fat and happy on Social Security. because it's assuming my income from the previous 2 years will continue forward for the rest of my life. And it's just not going to happen because I'm going to take a significant drop in income when you go from working for somebody else to working for yourself. That's just all there is to it. It's the nature of starting a business. But they don't do that at Social Security. Now, what's going to happen next year when my income takes a tumble, things will change. It'll be interesting to see what they say at that point, because I'm not going to make nearly the same money I did in 2016 or 17. So we'll see how much my income projections from Social Security drop off. But it still is interesting to see, because if you're getting ready to retire today and you're thinking you might stop working today, or not today, but say 5 years from now, and you say to yourself, I might stop working full-time, just go to part-time work, your Social Security benefit could change dramatically, because remember, it is using what you made last year and the year before, and they're going to anticipate you're going to make that same income the following years until you hit your retirement age. And if that's not going to be you, as it's not me, and it's not going to be a lot of people, because at some point they're going to, maybe go part-time. At some point, maybe they're going to just quit working. At some point, they might go volunteer over at the NICU down at the University of Virginia Hospital or something like that, like I've talked about before. But if Social Security doesn't adjust for that right now, which they can't, they don't know that, they're going to overestimate your income that Social Security is going to provide you, which could really, really, really put a kink in your retirement planning scenario. So you got to go online and make sure that stuff's up to snuff. Lastly, and I've said this before, I'll say it till I'm blue in the face, you got to go online and make sure AIME. Again, AIME stands for what? I can hear you. That's right. Average index monthly earnings. You've got to make sure that information is squared away. Go on there. It'll give you a list of all your earnings. It'll show me when I was in the Army. It'll show me when I was, like I said, washing dishes in Portland, Maine. It'll show me when I was making pretty good money in San Antonio. Just a few years back, the whole thing is going to show my entire earnings record. And I got to make sure that looks right, because if they're missing a couple of years, that could really, really, really hurt my total Social Security benefit. That's for sure. Now, one of the things that drives me up the wall is a lot of financial planners and clients will say, I'm not going to use Social Security in my retirement planning because Social Security isn't doing that great financially. Look, Social Security is not Medicare. Medicare is in a world that hurt by itself. That's all there is to it. The reason is we're just not paying the taxes we need to be paying to keep it fluctuating, or to keep it found solvent. There's just no getting around that. Social Security, we're paying a whole lot more taxes into it than we are to Medicare. But Social Security is still a whole lot better off than Medicare. There's no debate about that. At the end of the day, even the Social Security trustees say under current projections, we're only be able to pay 80 cents on the dollar. So let's just say it's worst case scenario, and you're only getting 80 cents on the dollar. Well, it's still 80 cents on the dollar, and I don't expect that to happen, but let's just say it were to happen. You're only going to get 80 cents on the dollar. Why would you not use that in your retirement planning nonetheless? It doesn't make sense. It's not like Social Security is not going to be there. Because as much as I love the free market, as much as FDR drives me up the wall, the facts are he put this program into place so future politicians couldn't get rid of it. And they can't. There's just no political will to do that. And frankly, that's okay. FDR knew what he was doing. He said, I'm going to put Social Security in place so it cannot be changed in the future. It cannot be gotten rid of. And that is why the benefits are the way they are. The vast majority of the benefits go to the lower income people. The lower income people have the most votes. There's no way they're getting rid of Social Security, my friends. It's not going to happen. As much as you don't want to plan for it, that's silly not to do that, because you're not going to get a true assessment of your benefit. You're not. Your benefit has a significant plan based on Social Security. And if you don't use it, it's not realistic. It's just not. So don't do that. And don't do this with hyperinflation, all this stuff too. It drives me up the wall. Oh, we're going to use a 15% inflation. Just stop. Use Social Security, use a 3% inflation. If you want to back off on Social Security, give yourself 80 cents on the dollar, that's fine. But do not use Social Security, because you're going to be missing the biggest portion of your plan is a tax you pay. If you're basing without Social Security, and now you're just taking from required distributions on your IRA or 401k, you're paying a heck of a lot more taxes than you should have in your annual analysis. And then as that flows into real world, you're paying way more tax than you should have if you did some proper planning. So do proper planning and incorporate Social Security. All right. So lastly, just go online. Oh, it's right here. Here's what they say. Actually, I find this interesting. Again, this is when I logged in. They tell us explicitly, we can't provide your actual benefit amount until you apply for benefits. And that amount may differ right here, and that amount may differ from the estimates we showed below because your earnings may increase or decrease, just like I said. Your actual benefits will be adjusted for COLAs, cost of living expenses. Your benefits are based on current law, and that's where all the people get, the new Congress is going to come in, they're going to change everything. And it's not going to happen. Cancel that. Your benefit, now this is the big one. Your benefit may be affected by, it's not the big one. They say by military service, it's not, right here. The big one right there. Your benefit, military service is not the big one. Your benefit may be affected by pensions earned through work on which you do not pay Social Security tax. Has nothing to do with the military so much. Has to do with the government pension offset and windfall elimination provision. So GPO and WEP. All right, I'm not going to get in those here today. That's another conversation I'll have with you later. But if you have a pension from the federal government, or a lot like back in Texas, a lot of teachers did not pay into Social Security because the Texas, their county tax, their benefits or pension is not part of the Social Security regime, so they don't pay into Social Security. Thus, they have a government pension offset, which only makes sense. You didn't pay into the system, you shouldn't get benefits from the system. It doesn't show that on the Social Security statement. So if you're a teacher and you're not paying to Social Security and TRS, Texas Retirement System, some in Virginia, not as many as I recall. Here in Georgia, I don't think there that many aren't in the Social Security system, but I don't know. If you're a teacher, you need to look up that yourself. Is your county or is your teaching retirement system part of Social Security system? If it's not, the government pension offset is going to affect you dearly. It's going to affect you dearly. So make sure you understand that, because that's a big deal, and it will not be reflected in your statement that Social Security provides you here today. It will only be affected when you actually apply. We cannot provide your actual benefit until you actually apply. So if you're a teacher, if you're a part of a government entity with a pension that did not pay into the Social Security system, your benefit is going to be well short of what they're showing you. I guarantee you that for sure. If you're a teacher and you have what's called a windfall elimination provision, where you're earning a pension based on your surviving or based on your spouse's record that was not, and you are earning a pension based on your teacher retirement plan that was not part of Social Security, you're also going to be dealing with a drop in your benefit as well, the windfall elimination provision, simply because, again, Social Security, and rightly so, they should not pay you benefits for money you did not pay into the system. That's just a fact. That's just a fact. And that's what's going to happen as a windfall elimination provision is for people who receive a pension as a beneficiary. Government pension offset are for people who are earning their Social Security, but also are earning a pension, typically a teacher or a government employee, but did not put into Social Security while they were in that pension system. So government employees, teachers, and beneficiaries need to be very, very careful of that. There is something for railroad employment. I don't know what that is. I guess I could learn it, but I'm not familiar with that. I'm not necessarily about military service, because military certainly pays into it. I don't know what the military service would be, but that'd be something. If that's you might want to look into it. But for me, I think that's minimal, but I might be wrong there. So don't take my word as gospel. All right, folks, that's it. That's what I want to talk about with Social Security. I do expect that I do encourage you to go on the system and get your stuff here, and you'll see where it says, your all the estimated benefits and whatnot. It's important to do that, and you really, really should, especially because they're not mailing them out anymore. All right, so if you have questions, comments, put them in below. Give me thumbs up. Thumbs up help me to promote the channel and for other people to see at YouTube. Don't forget to subscribe. Hit that little subscribe button down there, and then hit the notification bell to be notified of future content we do here at the Heritage Wealth Planning YouTube channel. For more info, just go to the website too, heritagewealthplanning.com, heritagewealthplanning.com. Look forward to seeing you on the next episode of Heritage Wealth Planning YouTube channel. Thanks, guys.